is so nice to see you on the show. Today we are going to talk money. This is Lowcountry Money Talk after all, and our expert Phil Bloyd has joined us to help us figure out really what to do with our money. Phil, nice to see you.
Good to be back.
We have a lot to talk about, but we always do. Today, let's walk through some things that we should really be considering. We do have a lot of people who are retired who watch this show, as well as people who may be nearing retirement here shortly.
Right.
We want to take some considerations given the bear market and really what we should be thinking about. So we start to get concerned, about maybe the prolonged downturn.
Absolutely.
All right, so let's just start with mindset. What should we be thinking about?
Don't panic. This is my 5th bear market.
Is it really?
Yeah. Okay. Don't want to show my age a bit.
You kind of did.
But this is my 5th one. So I kind of measure them up. I don't want to say, but I have this one pegged against another one that it's kind of reminding me of. This one a little bit differently though, because we're 30 trillion in debt. Chairman Powell did mention
that. Sounds like a lot of money.
He did mention that the other day. He was at a congressional hearing, and he said, these years of just constant spending and no regard for the national debt, he said that's going to affect things somewhat. So,
how could it not?
Yeah, you can only stretch your rubber band so far, and it breaks. But don't panic. Let's be proactive. Let's look over some things we can do. If you see I saw in the market there was a lot of fear the other day, and sometimes you see the fear because everything goes, for the day it seems like almost everything is down.
Right.
And it's like, wow, this one really shouldn't have been down, this one shouldn't have been down. But now we have, automatic trading, computers, you have stop losses that kick in, and then they just kind of feed upon the frenzy. So the first thing would be is don't panic.
Just don't panic.
Yeah.
Okay. Do the other P word, which is be proactive.
Be proactive. Let's say, okay, what can we do? What are some of the things that aren't working well?
Yeah, and you know what? One of the things we really do a lot on this show is ask you for advice about what to do with our money. Of course, that's what we're here for. But what about advice on what not to do with our money?
Sure. Okay. So let's not be reckless spending, like Washington, D.C. I'll just be nice and just say Washington, D.C. So we can't do that.
Yeah.
So right now, everything's kind of expensive.
Yes.
So if I have some major projects that I want done to my home, like my case, I need a new driveway.
Right.
I'm not paying today's rates on that driveway. Yeah. It's not going to hurt to sit there a few more months.
Right.
So if I have any major expenditures, but I'm like, I can put this off a little bit.
Yeah.
I would say we want to wait until fall, because if we do go recessionary, pricing will probably come back, and a lot of these workers will need work.
That's interesting. So the onset of the true definition of recession may balance some of these costs in a way.
Well, what the Federal Reserve is doing by raising interest rates, they want to slow the economy down.
Okay.
When we slow the economy down, it's hard on business. They've already started laying off in several big companies. So the banks are laying off in their mortgage departments. I know Tesla laid off like 1,200 people. So, if you go out now, you can see we need help. Of course, it's tourist season down here. But you're going to go from everybody needs help to where they're like, we don't need help anymore, and we're actually laying people off. That's when the pricing starts getting pretty cheap, when you need your new driveway, the lumber prices have started to come down, I need some work done on the house. So we want to put that off for now.
Yeah, it's really interesting how the teeter-totter, the balance of these things. But yeah, I mean, your point is very accurate. So maybe some of the best things we can do with our money right now is just hold off on the big expenses.
If we can wait.
Yeah, prices are high. People are having to pay higher labor wages. Ooh,
Sure.
That's a mouthful.
Wow.
We've got more mouthfuls to talk about actually after the break, because we're going to unpack some big ones for you today. More questions for Phil, and we're going to leave it at that for now.
All right.
We'll see you in a minute. Welcome back into the show, and it's been a good one already. We kicked it off talking a little bit about what to do right now and also what not to do with your money. Phil Bloyd is on the other side of this break with us, thankfully. Nice to see you back.
Good to be back.
Okay, well, we of course are talking to viewers who are in retirement, nearing retirement, because they've got a lot of questions right now. Rightfully so. As we're seeing a bear market, it does get a little dicey and makes us nervous. But here's the thing. One of the things you said to me on break, Phil, I want to talk about more, which is we don't want the stock market to determine when we can retire.
Right.
Okay. So how do we still make sure we have income in retirement no matter what?
Okay, great question. So, why would we want to let something that we can't control determine our retirement?
Yeah, we don't.
But many people do.
But right, yes.
And the main thing is because they're putting too much in risk assets. So go back to the rule 100 again. I live and die by, okay. So if I'm 55 years old, then I'm not gonna want more than 45% exposure to loss, equities. So on the 55%, that's going to be something where I'm not worried about, the market taking you take with it. As I get 60 and I'm still working, then I need to reduce to 40%. And then 70 if I'm still working, 30%. So by doing this, I'm not allowing that market to dictate.
Right.
Now, if I miss that, and I'm like, wow, I was like 80% in, aggressive because the 13 years and all that stuff was going so well. Again, if I can work a little bit longer, maybe I continue work. If it doesn't bother me, maybe I want to work, maybe I want to maximize my 401k contribution or my Roth 401k, which would be even better. There are provisions based upon age where you can put more into these. So if you're going to work another year or two, you may want to, you want to get your rule of 100 right, but you're going to want to maybe maximize and put some more in there in savings while you continue to work.
Okay, and I like the way you really make this sort of simple to understand, and the rule of 100 for viewers who are new to that is something we talk about on this show a lot, and it's essentially a simple math problem. How old are you and how much risk you should have based on your age. But no, I think it's a good point to talk a little bit about 401k provisions and allowing yourself to catch up a little bit if you did miss the mark on how much risk you should have. And let's just walk through with the couple minutes we have left of this segment. How do we really know when it's the right time to retire? I mean, we're talking about risk and maybe getting in a second opinion and having someone really take a look at where we are with our portfolio, with our money, and where we have things.
Well, the one thing I would recommend is you call Rachel, come in and do an income projection. So the income projection will say, okay, this is how much Social Security I'm going to get. This is how much I'm spending. It looks at your budget. This is my outgoing, this is my incoming. And it also takes a look at projections based upon investment savings and how much you're taking out each month. And if it goes into the red during normal life expectancy years, there's a problem.
Okay.
If it projects green all the way out, that means you're in the money the whole time.
Okay.
So that's the one thing we want to do is first do an income projection, and then that way we can say, okay, either we need to spend less, we need to gain more, or we need to cut expenses somewhere. We'll adjust that. But in this case, some people are like, well, this is what I'm going to spend. And I'm like, well, you're going to run out of money in 10 years.
Right.
So I hope that we can change something in here or
And you've talked on the show at length, actually, about ways to save money without necessarily even cutting back on your spending. You know, maybe there's you're paying too much in taxes and things like that.
One.
So that's the kind of thing
Expenses.
that they really take a look at. You dive into what is exactly happening and how can we fix that on the back end, and maybe make some adjustments on the front end as well.
Yeah, most people are paying too much in taxes and they're spending too much to have their assets managed. So So that's two areas we can clean up really quick.
Easy fixes. Oh, sounds easy, but I know it's you guys really dive in. Well, speaking of diving in, we've got more to dive in after this break, so we hope you'll stick around on Lowcountry Money Talk. We'll be right back. Okay, we've got more money to talk on Lowcountry Money Talk, and it's a good thing too because we've got Phil Bloyd here to help us do it. Revolutionary Financial Group, of course, joining us because there's a lot to discuss.
A lot
to discuss. We've already discussed a lot.
I wish it wasn't as much to discuss.
I know, so maybe
Busy.
It's too much.
It's summer. We need a break.
You don't get a break, Phil. We need
break.
you, sir. Okay. We're going to walk through some historical numbers for you on this show because this is really interesting stuff. And what you're telling me, Phil, is that history helps us determine really what we should expect here in navigating this bear market. So let's talk about that. Phil's fifth bear market. Did you know that? That was a fun fact.
I wish it wasn't, but the fifth one.
Oh, other fun facts. The S&P is down 21% since January 3rd. NASDAQ down 31.5 since November. So the Dow was down 16. All right. The average bear markets have taken 13 months to go from peak to trough. 27 months to break even. So what does that mean for us now?
That means that we probably, hit peak in the fall. Mm-hmm. We're not at the trough yet. So if history pans out, and I'm a history person, I'll tell you what, I took all the college history I could take until they threw me out and said we don't have any more history.
You've done it all.
We're doomed to repeat it. And when people come in and see me, Jessa, I'll always pull out the charts and I'm like, this is historical. This is what it always does. And we look at historical performances, this and that, because the market kind of runs in cycles and it repeats itself over and over. So if we look at that history and we say, okay, if this pans out, who wants to predict, but probably about 5 months, would be the 14-month mark.
Right.
So, we'll see.
We'll see.
And then the 2 years to break even. The one thing that I share with people at our events is if we have a 40% downturn in the market return, or in their market returns, and we get an 8% rate of return, it takes 6.6 years to get back to where you were. So we live in a society what wants immediate results.
Right.
You're gonna have to be a little patient with this one.
Right.
Okay. So let's see what brought us to this. If we're down too much, why?
Right.
Did we have too much exposure? The other thing we don't want to do is if the market is still heading down, we don't want to keep feeding into that. We want to readjust pull back a bit on the upticks in the market instead of feeding more down into it because it'll pull us down for even more.
Got it.
So I would take that to like someone that's at a casino table and they were up all of this money and then they got back to their start point and they're like, well, hey, I got to get all that back. And then they throw their good money in there and it leaves them down even further. So we don't want to do that.
Right. No. Okay, so what not to do? I want to talk about this Vanguard study too while we're talking a little bit about statistics, because this is one that retirees might find themselves in, and we want to make sure you avoid it. So the study estimates that if you enter retirement during a bear market with a balanced portfolio and you rely on it 100% for your income, it increases the chances of you outliving your money by 31%.
Yeah, definitely not fun there. So what we want to do is we want to make sure that when we enter that bear market, we have another place that we can go take income that will not be affected by the downturn in the market. So when I have a seminar and I'm speaking to people, I talk about a bear IRA and a bull IRA. Real simple. We have part of our IRA split in investments and prepared for a bull market. So when everything's lovely and the bull's running, you know, we may take our income and our required distributions from that side, because we have to take distributions.
Right.
That's another thing.
That's
So
required.
if I'm 72, you know, I'm having to take money out of my IRA. What if it's all in equities? I'm having to sell low, and we don't sell low, right? We don't want
don't sell
to.
low.
Okay. So if I don't have a bare IRA, and I'm cashing in equities at a lower rate to take my required minimum distribution, my IRA will not recover properly over those 27 months. So I need part of my IRA in what I call a bare IRA strategy, where if the market's declining, at least on this side of my IRA, these assets do not decline with the equity decline, and I can take my income from there without losing principal as far as the market pulling me back even further.
This is incredible information, Phil, and your strategies to keep us safe. You know, this is a fear that people are having, a very realistic fear. We're going to wrap up some of this information for you on the back end of this break, and it'll be the back end of this show as well. So we hope you'll stick with us for one more. We'll be right back. This is Lowcountry Money Talk, and we have talked about a whole lot of things. We always do. You know, Phil, I do want to spend our last segment here really talking about people's biggest fear. This bear market is not helping that. And the biggest fear, of course, out there, one of, is running out of money, especially during retirement.
Right.
So how do we manage that fear, right? I mean, we have to take income during a bear market. We need to pay our bills. But what do we do about that? Where do we take it from while we're, you know, trying to reposition our equities and really prepare ourselves for the next bull market?
Well, Jessa, as we always talk on this show, there's just historicals, there's certain rules, rule of 100, buy low, sell high, all these typical rules, right? So let's go back to the sell high and the buy low rule for a second. So we don't want to panic and just run everything into cash and just take a hit. Like I mentioned before, we want to sell as the market's coming up, because, you know, if I sell all of this, one quick thing would be when a client says, well, Phil, you know, what about this one? It's not doing so. I say, well, look, I'm going to sell yours, because when I sell yours, I know everyone else's will come up of that position, okay?
Right.
So, you know, we don't want to just wholesale maybe sell that a really well-named position, but what we might do is kind of ease out of it and sell some shares, because little by little, maybe it's moving up a little bit, maybe still in a bear market, we do have little bull runs in a bear market, you know, so we can have these upticks. So we want to kind of make sure, if we're overly aggressive, that we do the pullbacks during this time. But it's best that we don't take income out of these if we don't need it, okay?
Okay.
So the idea would be, if I have a lot of money sitting in the bank, I've already paid taxes on it more than likely, your emergency fund is 6 months expenses, and I have a year's expenses or 2 years expenses. Let's first deal with the bank. It's not paying you any interest, it's not paying you any, well, a little bit. We're not getting any dividends off these funds or whatever. So let's first of all take care of that.
Yeah. Okay.
Second of all, we do have an IRA. We have to take distribution.
Right.
If we miss our
there.
minimum required distribution, if we're over 72, it's a 50% penalty.
Yeah.
And that's not going to be
Not good.
So if my distribution requirement was 20,000 and I missed it, my penalty's 10. So I'm going to end up having to take 30.
Yeah.
Or more likely, write a letter to the IRS and plead for lenience. Please let me keep my right hand, don't chop it off.
Yes.
So, you know, things of that nature. So it's like, okay, we've got to take this out. So then the first thing would be, if I have excess cash money market in my IRA, okay, then I would want to take it from there. I wouldn't want to necessarily liquidate positions to get it, but if I already had extra cash there. The best way is not to get in that position in the first place.
That's exactly. So preparing yourself for these bear markets.
You don't want to run out of gas on the middle of the highway, so don't do it.
Right.
Make sure that you have your assets, especially in your IRA, positioned that you have probably several years' income that you can take out, still earning interest or whatever, but not tied into equities, but still in the IRA format.
Got it.
So that you can say, okay, I knew this was going to happen one day, so I can take my required minimum distribution out of the IRA portion, which I do not have tacked into the S&P or to the stock market equities, okay?
Okay.
And then that way you avoid the problem to start with.
I love your analogies. So don't run out of gas in the middle of the highway.
Simple.
Don't sell high. Prepare
Basic.
yourselves.
Basic.
We have a minute before we gotta head out here, but can you kind of wrap up the summer
Sure.
for us? What are we looking at?
All right,
here?
I think more pain, unfortunately. But, you know, it's not necessarily what's in front of us, it's how we react to it. So let's be positive, knowing that each day that we're down, we're closer to the end, and then we want to make sure that we have a nice grouping of equities to go to the next bull market, but we also want to make sure that we don't sell out too low and all these other things, don't have too much exposure. But I think, you know, we still have maybe some rough spots ahead of us here.
Absolutely, but the good news is you can really plan for that, manage it, make those pivots, have someone look at what you're doing. Most importantly, you gotta know where you are and where you measure against the market, and make sure you have enough money.
Get your analysis now.
Get your analysis now.
So you're ready.
I think that's it's always a good time, but especially when there's uncertainty. So the two biggest fears people have is running out of money and public speaking, and Phil, you public speak about not running out of
Right.
money.
Absolutely. I got 2 of them covered right
You should have your own show.
I should do that.
And he does. It's Lowcountry Money Talk. We'll see you next time.